Have you ever wondered how businesses manage their financial needs, especially during tough times? It's a question that has undoubtedly crossed the minds of many as we navigate the sometimes choppy waters of the business world. Businesses, like people, have financial needs. They need capital to maintain operations, to grow, and sometimes to keep their doors open during challenging periods. This need for funds can stem from various factors. Perhaps a business wants to expand into a new market, or maybe it needs to invest in new equipment to increase production. It could also be that a business is facing a temporary cash flow issue, a situation that can arise unexpectedly due to an unforeseen event or a seasonal dip in sales. These financial needs are not just about survival. They're about opportunities. They're about being able to seize the moment when a game-changing prospect comes along. They're about having the agility to pivot when the market demands it. In other words, having access to funds when you need them can be the difference between staying afloat and sinking, between thriving and merely surviving. But where does this money come from? Well, businesses have a variety of options. They might dip into their reserves if they have any. They might seek out investors willing to put their money into the business. Or they could turn to banks and other financial institutions for a loan. However, these traditional sources of finance come with their own set of challenges. They can be slow, bureaucratic, and often require collateral that a business might not have. And that's where things get interesting. Because in the modern financial landscape, businesses have another option. An option that can provide quick access to funds without the need for collateral, and with a repayment structure that's linked to the business's sales. This is where a merchant cash advance, or MCA, can come into the picture. So what exactly is a merchant cash advance? Let's dive right in. A merchant cash advance, or MCA, is a unique financial provision for businesses. But here's the twist. It's not a loan. Confused? Don't be. It's essentially a quick, accessible way for businesses to get their hands on capital by selling a slice of their future credit or debit card sales. Now let's break it down a bit. Imagine you own a small business and you're in need of immediate funding. Instead of going through the lengthy and often complex process of securing a traditional loan, you decide to opt for a merchant cash advance. An MCA provider gives you a lump sum payment up front. In return, you agree to give the MCA provider a percentage of your business's future credit or debit card sales. It's a bit like making a deal with a time traveler. You're essentially getting cash now in exchange for a portion of your sales that haven't happened yet. The MCA provider is betting on your future success, and you're getting the resources you need to make that success a reality. The percentage that you agree to give back is known as the holdback, and this holdback continues until the entire amount of the MCA is paid back in full. The beauty of this is that the repayment is directly proportional to your sales. If sales are booming, you pay back more. If sales are slow, you pay back less. Also, it's important to note that unlike traditional loans, MCAs don't require any collateral or personal guarantees. They're based purely on the performance and potential of your business. Now, while an MCA can be a valuable tool for businesses needing immediate cash, it's not for everyone. The costs associated with an MCA can be higher than traditional loans, so it's crucial to understand the terms before diving in. In essence, MCA provides businesses with the financial flexibility they need when they need it. And that's the beauty of it. It's a tool designed to help businesses thrive and to provide them with the means to navigate the ever-changing world of commerce. Now that we know what MCA is, how does it work? Let's dive right into the nuts and bolts of it. Merchant Cash Advance, or MCA, functions in a unique manner. Unlike conventional loans, it's intrinsically tied to your business's daily credit card transactions. Instead of a fixed monthly payment, the repayment is a percentage of your daily credit card sales. This percentage is known as the holdback. So imagine you're a business owner who has secured an MCA. Every day, a small portion of your credit card sales is automatically withheld, going straight to repay the MCA. This continues until the full advance amount, plus fees, is paid back. Now here's an interesting twist. The repayment amount fluctuates with your sales. If you've had a slow sales day, the repayment amount for that day will be lower. Conversely, if you've had a busy day, the repayment will be higher. This flexibility is a key distinction between MCAs and traditional loans. With a traditional loan, you're expected to meet a set repayment amount, regardless of how your business is faring. This can put a strain on your cash flow, especially during lean periods. But with an MCA, the repayment adapts to your business's highs and lows, providing a cushion during slower periods. However, it's important to remember that the speed of repayment depends on your daily sales. If your sales are strong, you could end up repaying the MCA quicker than expected. On the other hand, if sales are sluggish, it could take longer to pay off the advance. Moreover, the cost of an MCA can be higher than traditional loans due to its fees and higher factor rates. The factor rate is a decimal figure, usually between 1.1 and 1.5, that determines the total amount you have to repay. In the end, an MCA is a dynamic financial tool designed to move with the ebb and flow of your business. It's a unique blend of flexibility and accessibility, but it also requires a keen understanding of your daily sales patterns. So, MCA provides a more flexible repayment system for businesses, adapting to their highs and lows. Like any financial decision, MCA comes with its pros and cons. Let's start with the benefits, shall we? One of the key advantages of a merchant cash advance or MCA is the quick access to cash. In a world where time is money, this can be a game changer for businesses in need of immediate funds. No lengthy application processes, no waiting for weeks on end. With an MCA, businesses can get the cash they need in just a few days, sometimes even within 24 hours. Another benefit of the MCA is that it doesn't require any collateral. Unlike traditional loans, where you might have to put your property or other assets on the line, an MCA is unsecured. This means that your assets are safe, even if the business hits a rough patch. Then there's the repayment structure. With an MCA, repayments are tied to your sales, so if you're having a slow month, your repayments decrease accordingly. This makes an MCA a flexible funding option that can adapt to the ebb and flow of your business. But just like a coin has two sides, MCAs have their downsides too. One notable risk is the high cost. Merchant cash advances can be more expensive than traditional loans, with annual percentage rates that can reach triple digits. The repayment structure, while flexible, can also impact your daily cash flow. Since repayments are made daily, businesses need to ensure they have enough cash on hand to cover both the repayment and their operating expenses. Lastly, there's the risk of getting in over one's head. Due to the easy access to funds and the lack of collateral, it can be tempting for business owners to take on more debt than they can handle. This can lead to a cycle of debt, where businesses take on new MCAs to pay off old ones, which can be detrimental to the long-term health of the business. Therefore, it's crucial for businesses to weigh these factors before deciding on an MCA. So, what are the key points to remember about merchant cash advance? Firstly, let's make sure we're all on the same page. A merchant cash advance isn't a traditional loan you might be familiar with. Instead, it's a purchase of your future sales. Think of it as an advance on your upcoming revenue. The provider is basically buying a portion of your future credit card sales in exchange for instant cash flow. One of the standout features of MCA is its speed. It's a financial solution that delivers quick access to cash, often within a few days. This makes it a go-to option for businesses that need a rapid injection of funds to seize an opportunity or navigate a rough patch. Another key point is the repayment structure. Unlike conventional loans with fixed monthly payments, the repayment of an MCA is tied to your daily credit card transactions. This means that on slow business days, you'll pay back less, and on good days, you'll pay back more. It's a dynamic payment model that moves in step with your business's performance. However, it's not all sunshine and roses. There are a few considerations to bear in mind. Remember, the cost of an MCA can be higher than traditional loans. The factor rate can sometimes translate into triple-digit annual percentage rates, making it a pricey option. Additionally, the daily withdrawals could impact your cash flow. While the repayments adjust according to your sales, they are nevertheless frequent and could potentially strain your business's finances. Lastly, the lack of regulation in the MCA industry can lead to unscrupulous practices. It's critical to read the fine print and understand the terms before signing on the dotted line. Remember, a merchant cash advance can be a useful tool for businesses in need of quick cash, but it is essential to understand the details and potential risks before diving in.